The US Central Bank, the Federal Reserve, kept rates unchanged at between 0.25 and 0.5% at its meeting on the 15th of June, while the decision itself was in line with forecasts after a brutal May jobs report. The Fed cut its own forecast for US economic growth in 2016 to 2%, down from 2.2%. Also mentioned a big unknown, the next week's EU referendum for the UK's membership of the European Union. Wei Li joins us now from iShares at BlackRock. Welcome. Was this to you an issue of one particular event that really tipped the Fed, or was it a cocktail of issues, do you think, that was facing the Federal Reserve in its decision?
I think it's definitely a mix of factors that drove the non-decision, non-rate hike. And if you think about consideration for market volatility, these last few days has really been quite volatile, with markets waking up to the prospect of Brexit risk a bit more meaningfully than before. So this is one consideration pinning them down in terms of not hiking rate. If you think about the numbers in terms of growth, in terms of NFP, that have also been reasonably poor, so once again pinning them down from the rate hike trajectory. And I would say, as a result of that, the decision of not hiking rate in June was not really a surprise. But what did catch market by surprise is really the degree of dovishness that has been expressed through the statement itself, with more people now thinking that maybe just one rate hike for this year. This
is the problem, isn't it, about forward guidance from the Fed? It's just a few weeks ago, Janet Yellen was saying expect an interest rate rise, or intimating an interest rate in the coming months. Well, here we are now in June. Is July, do you think, still on as a possibility?
If you look at the Fed Fund Future implied probability for July, it is now around 15–14%. So definitely dropping very meaningfully from even 1 day ago. July is not looking as likely as before, definitely. And even Janet herself, Miss Yellen, she talked about previously looking to hike rate in a few months' time. But the latest speech, early June, she removed the reference of a few months, looking as though she wanted to give herself the flexibility of extending the horizon over which she could potentially start hiking again. So I think she saw a few tail risks events in the horizon, and she would like to buy herself that degree of flexibility.
Let's look out from there on. If it's not July, then you've got to look at September. I think it's September 21st or 22nd, I think it is. That's getting very close, the 8th of November, which is the presidential election.
Yes, absolutely. I think September, well, more likely than July, but maybe even later this year, towards the year end, after the election is out of the way. I think this consideration around timing being wedged in between key events are really why more Fed members, now 6 compared to 1 before, think that one rate hike is perhaps what they can get away with for this year.
Yeah, we've mentioned about the growth expectations there and the slowing down we've got of those evidenced with the forecast. What about that jobs report, that 38,000 print that we saw for May? Do you see a correction of that? Do you see that that was just far too far undershooting expectations? Do you think there might be a revision and a bullish jobs number over the summer that might start to correct that?
There is definitely seasonality factor, but it is not super likely that we would have a significant reversal of that number all the way to where we were before, mid 100 to 200K headline job creation, because the amount of slack in the labor market is not really as much as people think. A lot of people have left the labor market for good and not coming back. These are structural issues. And if you think about the fact that the wage pressure is building up in the labor market, it indicates that the slack is going away as well. So we're just at this cycle at this point in the cycle where headline job creation is perhaps just starting to moderate compared to the levels that we saw before.
One other factor we've spoken about before in the context of the Fed is China. I don't believe it was mentioned. It certainly wasn't mentioned in any great detail, I don't think, in the statement. What about China? Is that still a risk?
China, if you think about the latest announcement from related to China, would be that the MSCI did not include the domestic iShares market into its broad emerging market MSCI benchmark, and that didn't cause significant risk reversal of the Chinese stock market. And I think in terms of Fed's consideration of China, if China were to cause significant risk off on a global basis, then it would get to the Fed's radar in a very direct fashion. But because Chinese equity market actually have been holding up reasonably well in response to this non-inclusion decision, means that they have become less of a tail risk compared to before, and this should also be read in conjunction with the fact that data in China have been stabilizing. We're seeing yes, credit growth have been coming down, but at the same time we're seeing growth stabilizing at albeit a low level, and I think this is the sort of prodding along situation where we could have China kind of in the background but not really at the forefront of global risk consideration.
Okay, but in balance, you see potentially one rate hike now from the Fed this year.
That definitely is where market is considering for this year, and our expectation have also been moderated because of the yesterday's meeting.
Yeah. Okay, all right, that's great. Thanks so much indeed, Wei Li there from iShares at BlackRock.